So hello friends, welcome to my channel MN Coaching Center. So today I'm going to explain your Chartered Accounts second chapter, Accounting Concept, Principles and Convention Part 2 video. Let us come to the Part 2 video. Here they have given a illustration, means they have developed the accounting equation from the following information. How we can develop the accounting equation. For that they have given an example. Let us see. Here they have taken April 1, 2014 to March 31st, 2015. How much transaction it has happened. So capital 1 lakh, but March 31, 2015, how much capital was, don't know. 12% bank loan they have taken, and that is April 1st, 2014 it is 1 lakh, and March 31st, 2015 it is 1 lakh only. Trade payables 75,000 in April 1, and in March 31 it is 70,000. Fixed assets it was 1,25,000, but in March 31st it is 1,10,000. Trade receivable it is 75,000 in April, but in March 31st 2015 it was 80. Inventory it is 70,000 in 2014, in 2015 it is 80,000, and cash and bank 5,000 in 2014 and 6,000 in 2015. So we have to find the profit of the year by this we have to balance the sheet on 31st 3 2015. Now for answer for this, so equity is equal to capital, that is capital is 1 lakh. 1 lakh, okay, you keep that aside. Capital is equal to 1 lakh. Equity is equal to capital. Equity means capital, okay. Liability means bank loan plus trade payables. Here bank loan is 1 lakh, trade payable is 75,000. When we add it, we will get 1,75,000. Next, assets. For assets you have to add fixed assets, trade receivables, inventory, cash and bank. So when you add all this, you will get 2,75,000. So now you have to add equity plus liability, you will get assets. What is equity? Capital. Capital is 1 lakh rupees, means how much you have given expenditure you have done. And liability is 1,75,000. Total it is 2,75,000 assets. See, total amount you have got correct. Now for the year end, assets is 1 lakh, 10,000, 80,000, 80,000, 6,000. Here see, 1 lakh, 10,000, 80,000, 80,000, 6,000. This one is the assets. And next liabilities here, 1 lakh, 70,000 liability. Here 1 lakh, 70,000 you have to take. Now when you add assets, it will be 2,76,000, liability 1,70,000. Now equity is equal to assets minus liability. So therefore equity, to get equity is 2,76,000. What to get? Minus 1,70,000 here. Here by adding these both, what you got? These both. It is the liabilities, because it is the loan you have taken. Trade payables you have taken, but fixed assets you have given. Trade receivables, cash and bank you have given. So these four amount you have given to them. But 12% bank loan you have taken from the bank. Trade payables you have taken from the trade, what you have done. So totally equity is assets minus liability. So therefore it will be 1,06,000 is the amount you get in equity. Profits is what you got, how you know, means 1,06,000 minus 1 lakh. That is the 1,06,000 is the here equity minus here equity capital of 2014. When you minus that, what you have spent in 2014, 1 lakh you have given expenditure, totally you will have 6,000. So like this you have to explain. This is the illustration. This is how you have to find the profit, how you got in that balance sheet, and you have to balance that sheet. Next is conservatism. So conservatism, it states that the that accountant should not only take anticipate the income issue. They should provide all possible losses. They should also give all possible losses that are happened to the company. They should give information to the manager of the company. When there are many alternative values, when there are many values of assets, alternative values of asset, and accountant, they should choose only the method, that method that leads to the lesser value, that takes them to the lesser value. Later on, they shall see that after that they shall see that the golden rule of current assets valuation, that is the cost or market price, whichever is lower, the cost of market price that is lower or originated, that should be originated from the concept. Next, the realization concept also states that that there should be no change should be counted. They should have no change unless it has materialized. There should be a material that you have taken. Till that there should be no change in concept. The conservatism concept, it puts a further break on it. The conservatism concept, it puts a break on it, and it is not prudent to count unrealized gain. They does not prudent to count the unrealized, that they have not realized that gain they could not take here. But it is desirable to guard against all possible losses. It is, you can take all possible losses and you can explain them. For this concept, there should be three qualitative characteristics in financial statements. The first one is prudence. So they should have judgment. They should have judgment about the possible future loss. They should know which will be help them, which are to be guarded, and as well as gains which are uncertain. They should know about that. Next, neutrality. So unbased outlook. So they are that are not based, unbased outlook, that is required. That are required to identify and record the possible losses. That are help them to record the possible losses as well as the excluded uncertain gains, that helps them to know about the uncertain gains and possible losses. That will be the neutrality. Next, faithfully, that is the representation of alternative values. Representation of alternate value is called as the faithfulity. Next is consistency. In order to achieve the comparability of financial statements of an enterprise throughout a period of time, the accounting policy or should be followed by the accountant consistently for an period of another period to one period to another period. For a period of time, they should follow the accounting policy, and a change in the accounting policy, it may lead to the certain expectational circumstances. They may have some problems if they make changes in accounting policy. So the concept of consistency is applied particularly. They are applied particularly when they took alternative methods of accountings. They are equally accepted. When they take alternative method of accountancy, then they are equally, you can accept it. Like example, a company, they may adopt any of several methods of depreciation. They can adopt such as written down value method, straight line method, many other methods. Likewise, there are many methods for valuation of that balance sheet or for the accountant. But by following the principles of consistency, it is advised that the company should follow consistently over a year the same method they should follow. They should not change any method of depreciation, or the same method of valuation of inventories that is chosen by them should be continued. However, in some cases, though there is no inconsistency, they may seem to be consistently, apparently, There should be consistency apparently they can see. In case of valuation of inventories, if the company applies the principle, if the company applies the principle at cost or market price, whichever is the cost or market price that is lower, and if these principles accordingly it results in the valuation of inventories in one year at cost price and the market price in the other year, there is no inconsistency here. It is only an application of the principle. But there are some of the concepts of consistency that does not imply non-flexibility. It does not allow for the non-flexibility as not at low that not allow the introduction of improvement method of accounting. So accounting should change its accounting policy in any of the following circumstances. They can change their accounting policy, like to bring the books of accounting in accordance with an issued accounting standard, and to compliance with the provision of law. And when under changed circumstances it is felt that new method will new method may reflect a more true and fair picture in the financial statement, they can change their accounting policy. Next, after that, the next topic is materiality. A materiality principle that permits other concepts to be ignored. It makes other concepts to be ignored. If the effect is not considered material, if that effect that happened to the accounting is not considered as material, this principle is an exception. It will be exception to fulfill some disclosure principle. To fulfill the disclosure principle, it will be exception. It will be exception. Sorry. According to materiality principle, all the items that having some significant economic effect, all the product items that have some significant economic effect, it will happen, true effect will happen of economic effect will happen on the business for the enterprise, that should be disclosed. They can disclose it in the financial statement. And any insignificant item or products which will only increase the work of the accountant, but will be relevant to the users, that will be relevant to the users, but it will increase the work of the accountant. They should not be disclosed, and they should not disclose it in the financial statements. Next, the term materiality is the subjective term. The term materiality which we get, it is a subjective term. It is on the judgment. It is the judgment, common sense, and discretion of the accountant, that which product is material and which is not. So they can the accountant will have the knowledge that which is product, which is not a product. They can classify. For example, a stationery purchased by some organization, though it is not used fully in the accounting year, for a 1 year they do not use that product, but still that is shown as the expenses of the year. They have to show that that is the expenses of year, because it belongs, because of the material concept, because it is a material. They have buy that material, but that if they not use also, they have paid the money. So the accountant will show that as the expenses. So similarly, depreciation on small items, they are like books, calculator, etc., is taken as 100%. They are taken as 100% in the year of purchase. In the year of purchase, they take it as 100%. Though it is used by the entity for more than an year, they use for in the entity. This is because the amount of books or calculator is very small. The amount of books is very much small, and calculator is also very much small to show. It cannot be shown in the balance sheet, though it is an asset of the company. It will be asset of the company. The materiality depends the material depends not only upon the amount of the item, but also upon the size of the business, nature and level of information, level of person making the decision, many other things it depends. Moreover, an item material to one person may be immaterial to another person. So a person having the item material may be immortal. It does not like the another person. It can that product cannot be liked by another person. What is the important? What is important is that omission of any information should not impair the decision making of the various users. So what what information they get, it should not be making it should not the decision taking should not be done by the various users. Next, fundamental accounting assumptions. There are three fundamental accounting assumptions. First one is going concern, consistency and accurate. All the above three accounting assumptions, they have been explained in this unit already. You have learned about this. So if nothing has been written about the fundamental accounting assumption in the financial statement, if it does not write anything, then it is assumed. Then you can assume that they have already been followed. You have followed it in the preparation of the financial statement. You have followed the financial fundamental accounting concept you have already followed. However, if any of the above method any of the above mentioned fundamental accounting assumption, if it is not followed, then it may affect this affect should be specially disclosed. This affect should be disclosed if it does not use that fundamental accounting assumption concept. Next, financial statement. The aim of accounting is to keep systematic record to ascertain financial performance and the financial position of the entity, to give the financial position of the entity and to communicate the financial information to their customer, to their managers, to their users of the group. And the financial statement are the basic means through which the management of an entity makes public, which the management of an entity makes it as public. um, they are they makes it as public. They are structured financial representation of the financial position. So they are the financial structure of financial position enterprise. It also tells us about the performance of an enterprise, and to have the record of all the business transaction, and to also to determine whether all the transaction resulted in either profit or loss the transaction has got in that period. All the entities will be prepared financially statement. They will prepare like balance sheet, profit and loss account, follow statement, many other things by using accounting concept, principles and conventions, which we have already discussed in this para 5 in many things. In many this all you have learned. Next, qualitative character of financial statement. So as financial statement has some of the qualitative character are the attributes. They are the attributes that make the information provided in financial statement. That information that you get will be useful to the users. The information that you get in the financial statement will be useful for the users. The following are some of the important qualitative character of the financial statement. Some of the important qualitative character of the financial statement, they are the understandability. So an essential qualitative of the information provided in the financial statement is that it must be readily understandable. The financial statement that we provide, it must be understandable by the user or by the manager. Whoever sees that he can understand. What you have done, you have taken the money, you have written, we have spent the expenditure, you have written assets, you have written liabilities, everything you have written. Yes, they can understand. For this purpose, we can assume that the users have a reasonable knowledge of their business. They will have a knowledge of their business by seeing this. And economic activities and economic activities and accountings and study and economic activities you can have and accountings you can have and to study the information with a reasonable diligence. It is important. So you can have information about complex matters that should be known in the financial statement because of its relevance to the economic decision making. That needs of an user that user should not be excluded merely on the ground that it may be too difficult for some certain users to understand these accounting concepts or this concept. Relevance. To be useful to be useful, their information must be relevant for the decision making needs. They should be relevant for the persons who take the decision making in that company, that they manager, owner, or anyone. It should be relevant for them. And the information has the quality of relevance. The information has the quality of relevance that when it influence the economic decision of the users by helping the evaluate past, present, or future events, or confirming or correcting their past evaluations. By confirming or correcting their past evaluation, they can predict and confirmatory roles of information, and they can interrelate each of them. Like example, information about the current level they can take and structure of assets holding. They has the values to users. When they endeavor to predict the ability, they have to predict the ability of the enterprise so that they can take the advantage of the opportunities, and also its ability to react to adverse situations, its ability to react against adverse situation. And the same information plays a confirmatory role in respect to the past predictions about this in respect to the past prediction about this. It plays a confirmatory role. For example, the way in which the enterprise should be structured or the outcomes of planned operation. It should be the outcome or the way they should plan about this. So information about the financial position and past performance, they should be frequently used by the managers or the company owners so that they can predict what happens in the future or about their financial position and what will be their performance in the future, and many other matters. To know about this, they should be continuously knowing about they should have continuously information about financial position and past performance continuously. And also they should use the directly in they should be directly interested, and other matters in which the users they should be directly interested on the other matters, and such as dividend and wage payments, share price movements, and the ability of the enterprise to meet its committee member as they fall due. These are the works they can do, and to have predictive value, the committee members to have the predictive value, information need not be in the form of explicit forecast. It should be not in the form of forecast, and the ability to make predictions about the financial statements in any chance. However, these manners in which information on past transaction and events they are displayed. For example, the predictive value of the statements of the profit and loss is enhanced. It is enhanced if it is unusual, abnormal, and infrequent items of incomes and expenses, or they are disclosed and they are finished. Next, the third one is the reliability. To be useful, to be useful, the information must also be reliable. They are to be useful for the people or for the manager. The information that the accountant give it should be reliable. Information has to be has the quality of reliability. Information has some of the quality of reliability when the reliability is free from material error and biases, and can be dependent. The reliability can be dependent upon by the users. It can be dependent upon the users to represent faithful, that which to represent their faithful, which it either purports or to represent or could reasonably be expected to represent, the reasonably be able to expect them to represent. So information that may be relevant but so unreliable, they may be relevant also but so unreliable in nature, or representation that its recognition or recognition may be potential misleading, that recognition may be sometimes potentially misleaded. So for example, if the validity and amount of a claim for damages under a legal action in the enterprise, they are highly uncertain, and it may be inappropriate for the enterprise to recognize for the enterprise to recognize the amount that he has claimed in the balance sheet. It may be inappropriate. So although it may be or may be appropriate to disclose the amount and circumstance of the claim, so you cannot disclose, it may be appropriate. Although it may be appropriate, you can disclose the amount and circumstance of the claim, you can disclose. Next, comparability. So users must be able to compare the financial statements of an enterprise through the time being, in order to identify the trends changing, as there will be changes in the world every day, today or weeks to weeks. There will be a new change in its financial position also, to know about the trends in the financial position also, and the performance and cash flow also. To know about this, the comparability is also important. Users must be able to compare. The users who takes the product, or the managers who take them, they may be able to compare their financial statements of different enterprise in order to get their relevant financial position, to know about the relevant financial position and performance and the cash flow of that company, to know about this, the comparability is important. Hence the measurement and display of the financial effects of like transactions and other events must be carried out consistently throughout an enterprise and over time for that enterprise, and in consistency way of different enterprise, they should go ahead. So an important implication of the qualitative characteristics of comparability is that users be informed of the accounting policy. The users will be informed about the accounting policies, and they will be employed in the preparation of the financial statement. They will be employed in the preparation of the financial statements, and any change in those policies and the effects of such changes, any change happened in those policies and the effects of that changes is said as comparably. And users need to be able to identify, the user should identify the difference between the accounting policies like transaction and other events, to know about the difference between the accounting policy for transactions and other events. And So sorry friends, so there was a problem here. No problem, let us come now you can hear, I think so. So next, compliance with the accounting standards, that includes the disclosure of the accounting policies that are used by the enterprise, and it helps them to achieve the comparability. And also they need the need for comparability. They should be confused with the mere uniformity. With uniformity also they may be confused, and should not be allowed to become an impediment. It should not become to the introduction of the improvement of accounting standard. For impediment for the introduction of the accounting standard, it should not become. And it is not appropriate for an enterprise to continue accounting in the same manner. To continue the accounting in the same manner, it is not appropriate for then accountant to continue the accounting in the enterprise to continue the accounting in the same manner for a transaction or the event if the policy adopted by them is not in keeping with the qualitative character. It is not in keeping with the qualitative characters of the relevance and reliability, and it is also inappropriate. It is also inappropriate for an enterprise. It is also inappropriate for an enterprise to leave their accounting policies unchanged when more relevant and reliable alternatives they have. And users wish to compare their financial position, performance, and cash flow of an enterprise over a time. They like to compare these things with their opponents or with their other big companies. And also hence it is important that the financial statement shows corresponding information for the preceding periods. They show the corresponding information for the preceding periods. The four principal qualitative characters and understandability, relevance, reliability, and comparability. These are the four principal qualitative characters. Next, materiality. So the relevance of information is affected by its materiality. So the relevance of the information is affected by their materiality. Information is a material. If it's a misstatement, it could influence the economic decision. They may influence their economic decisions of users. They may affect the user's decision taken on the basis of the financial statement information. It may it got influence. And materiality depends on the size. Nature of the item or error, and judged on the particular circumstances of its misstatement. And materiality also provides a threshold or cutoff point. It tells us rather than being a primary qualitative characteristics which the information must have if it is to be useful. They may have that information. Next, faithful representation. To be reliable, information must be represented faithfully, and the transaction and the other events it either purports to represent or could be reasonably be expected to represent. It may be easily expected to represent it. And thus, for example, let us take a balance sheet should represent faithfully the transaction. It shall tell about the transaction and other events that result in the assets, liabilities, and equity of the enterprise, and at the reporting date which meet the recognition criteria. So most financial information is subjected to some risk it has of that are being less than a faithful representation of that which our purports of portray. And this is not due to the biases but rather than inherent difficulties. They either to identify the transaction and other events to be measured. To identify the transaction and other events, it should be measured, or in devising and applying measurement and presentation techniques that can convey the message that correspond. They can give the message that correspond with those transaction and events. In certain cases, the measurement of the financial effect, the measurement they take about the financial effect of that item, the product could be so uncertain. It could be so uncertain, it cannot be explained, that enterprise generally they would not recognize it, they could not recognize them in the financial statement. They could not see that in the financial statement. Like example, although most enterprise generate good, most enterprise generate goodwill internally over time. They will generate goodwill internally over a time. It is usually difficulty. They find usually difficulty to identify or measure that goodwill will be reliably or not. In other cases, however, it may be relevant to recognize items and to disclose the risk of they may disclose the risk of errors that are surrounding their recognition and measurement. They may disclose it. So okay friends, this was your chapter accounting concepts and principles and conventions part 2 video. So still 1.5 page over there. Let us see if I can complete. I will complete now only. Still 1.5 page means let us try to complete. So substance over form. So if information is to represent faithfully the transaction and other events, so and the information is to represent the faithfully about the transaction and other events that it purports the represent, it gives the representation, it is necessary that they are accounted for and presented in accordance. They are accounted for and presented in the accordance with their substance, what they are accounted and recorded with their substances and economic reliability they should have, and not merely their legal form they should have. They should not have merely their legal form, but the substance of transaction or other events. There is not always consistent. They are not always consistent with that what is with that which is apparent from their legal or contrived form, For example, where rights and beneficial interest is in an immovable property, they are transferred, but the documents and legal formalities are pending. And the recording of acquisition disposal would be disposal would in substance represent the transaction. They should represent the transaction entered into that. Next, neutrality. To be reliable, the information contained in financial statement, it must be neutral. It must have the information, and that is free from biases. So financial statements, they are not neutral if by the selection or presentation of information they are not neutral, but they influence the making of decision or judging in so that they can give in order to the they can give the they can achieve the predicted result or outcome. They can take the decisions or the judgment that they take. It may sometime it may give the predicted results or outcome. Next, prudence. Sorry, 1 minute. Next is prudence. So the preparers of financial statements have the content with the uncertainties that inevitably surrounded. They may be inevitably surrounded by many events and circumstances. They may be surrounded such as the collectability. They may be surrounded with collectability of receivables, or the probable useful life of plants and machineries. They have useful lives of what they have spent, and the warranty claims that may occur, the warranty claims they may take that may occur. Such uncertainties or they are recognized by the disclosure. They may be recognized by the disclosure of their nature and extent, and by the exercise of procedure in the preparation of finance statement also they may exist. And also prudence is the inclusion. It is the inclusion of a degree of caution. It is the inclusion of taking the degree of caution in the exercise of the judgments. In doing the judgment needed in making the estimates that are required under conditions of uncertainty, judgments that are required at the condition of uncertainty, such that assets or income are not overstated. The assets and income are not overstated, and liabilities or expenses are not understated. They are not understated, and assets or income are not over. It may not become. However, the exercise of prudence does not allow. The exercise of prudence does not allow. For example, let us take the criterion. Let us take the criterion of hidden reserves or excessive provisions, the deliberated understatements of assets, the assets or income, or the deliberated overstatements of liability or expenses. Because the financial statement would then not be neutral, and therefore not have the quality of reliability. The financial statement not have the quality of reliability. So, full, fair and adequate disclosure. So the financial statement must disclose all the reliable and relevant information about their business enterprise. They should disclose business enterprise to their management. They should disclose all their reliability relevant information what they have. They should disclose to their business about information about their business enterprise to their management. They should tell all the information. They should give all the information, and also to their external users, for which they are meant. For them they should give, means they should give all the information to them. um, and which in turn they will help them to take the reasonable and rational correct decision. They will help them by having this information. They will take the correct decision. For this, it is necessary that financial statements are prepared in conformity. The financial statement may be prepared in the conformity with generally financial statement will be prepared with generally and accepted. They may accept the accounting principles. They may accept, and the information is accounted. The information is accounted for, and it are presented in accordance. The information presented in the accordance with the substances. The information is presented with with the accordance of the substances and economic reliability. It is made, and not merely with its legal form. It is not made with its legal form. The disclosure should be full and final. The disclosure should be full and final, so that the user can correctly assess the financial position. The users can know about the financial position of their enterprise. Next, the principle of full disclosure implies that nothing should be omitted. The full disclosure tells us that nothing should be omitted while the principle of fair says that disclosure implies that all transaction recorded should be accounted in the manner, and all transaction that is recorded, it should be recorded in that manner that accounting should be accounted in that manner that financial statement of the proper true and fair view. They will give our the financial statement they will give us the true and fair view of the resultant of the business of the enterprise. And adequate disclosure, the adequate equal disclosure implies that the information influencing the decision of the users, it gives us the information about the influence of the users should be disclosed. The information of the influence of the users decision may be disclosed in the detail, and should make some sense. It should have some sense. If they are closed also, they should have some meaning. And this principle, it widely used in the corporate organization, because there are separation in the management and the ownership they have. So that way it is used in the corporate organization. And the Companies Act that was brought in 2013 in pursuant of the principle. The company has come out with a format of balance sheet, profit and loss account. It has come out with a new format, and this disclosures of all the major accounting. It is disclosed about all the major accounting policies and other information that are to be provided in the form of footnotes. For them, and anchors it is provided, and many other things. And practice of appending notes to the financial statements is the outcome of this principle. So practice is the outcome of this principle. Next is competency. So to be reliable, the information in the financial system must be complete. Should be complete within the complete within the bounds of materiality and cost. It should be complete, and an omission can be cause. An omission can cause information to be false and misleading. It may be, and thus unreliable and deficient in the terms of its relevance. It may be sometimes wrong. So thus, if accounting information is to give the present faithful, the transaction and other events that is purports to represent, it is necessary that they are accounted for the presented in accordance with their substance and economic reliability, and they should be not taken by their legal forms. They should not take, for example, if a business enterprise sells its assets to other but still uses the assets as usual, they still uses their assets as usual for the purpose of their business. By making some arrangement they to continue their assets with the sellers, it simply becomes the legal transaction. It becomes a legal transaction, and the economic reality is that the business is using their assets as usual for getting their benefits. So financial statements information should be contain the substance of this transaction. The financial statement has some substance of this transaction and should not only record going by legally. They should not record going by legally. In order to be reliable, the financial statement information should be sometimes neutral and should be free from bias. And the prepares of financial statement, however, they should have to be contained with the uncertainties. They should have containment with the uncertainties and that are inevitable, that are sometimes inevitable, and they may surround many events and circumstances they may have, and such as the events and circumstances such as the collapsibility of difficulty receivable and the profit and the probably useful life of the plant's equipments and number of warranty claims that are made by that company. Many occurs they have done such uncertainties that can be recognized in the disclosures of the nature, and they can extend, and by exercise of the precedence and by the preparation of the financial statement they can have this. And prudence is the inclusion, there is the inclusion of degree of caution. It is the taking of caution in the exercise of the judgment, that are needed in making the judgment, that are needed in the making the estimated required under condition, that are required for the under condition of uncertainty, such that assets and incomes they are not overstated. The assets and income are not overstated, and loss and liability they can be understated. The assets and incomes are not overstated, and loss and liability are not understated. So this was your chapter. The meaning, the accounting concepts, principles, and conventions. So here you have some of the questions in this. Here you can see. Here you have some questions. See here also you have some more questions of accounting principles, accounting concepts, principles, and conventions. So this is your question. You can solve this question. So okay, friends, I think you understand your accounting principles, accounting concepts, principles, and convention chapter. So okay, friends, I will see you in my next video explaining another chapter. So till then, take care, have a nice day, bye my dear friends.